In this video, I will show you how to use straddles and strangles to profit in options trading. Focus of this video is on using straddles and strangles to identify trend and momentum in market and then knowing how to use this in options trading. So let's get started. Let us first have a brief overview of what a straddle is. A straddle is when you buy call and put option with same strike price and series of the same underlying. For example, if a stock is trading at 100, to create a straddle, you would buy 100 strike price call and 100 strike price put. In the chart in front of you, I have created straddle for the same example. So premium of 100 strike price call is 20 and for 100 strike price put is 20. Therefore, break even for this straddle would be strike price plus premium and strike price minus premium. Since strike price is 100 and premium for both calls and puts is 20, break even for this straddle would be 80 and 120. What this means is that as far as price of stock moves above 120 and below 80, trader is set to make profit. Let us now move to strangles. A strangle is when one buys out of the money call and out of the money put of same underlying in the same series. For example, if a stock is trading at 100, one can create a strangle by buying 120 strike price call and 80 strike price put. Assuming premium for both call and put is 20, break even for this strangle would be 140 and 60. Now break even in strangle is calculated as strike price of out of the money call plus premium and strike price of out of the money put minus premium. So let me now explain why straddles and strangles are helpful in range-bound market, trending market and momentum-driven trending market, and why you should be tracking this on a consistent basis. Now in range-bound market, where price remains in a broad range, straddles and strangles lose money over time. In this scenario, as momentum is missing, premiums in both calls and puts usually decline due to time decay. If you spot strong price action and then find straddles in a downtrend, you would then know that element of momentum is missing. Now this is vital information as you can plan your trade accordingly. In a range-bound market, one should be looking to sell straddles and strangles, provided volatility conditions are fulfilled. In trending market, premiums in calls or puts move higher. In this case, you will have to check for element of momentum. If momentum is missing, eventually straddles or strangles will consolidate and trend higher with less momentum. While this is still positive, it is not ideal as value of calls and puts combined won't rise at a rapid rate. When market is trending, avoid selling options and look into buying straddles and strangles. Profit will be limited, but you would still make decent returns. In momentum and trending market, premiums in calls and puts combined together will head higher. This is when you should be looking to buy straddles or strangles as you will benefit a great deal. As an options trader, ideal scenario for you is to be in a trending market with strong momentum. As trend will strengthen, either calls or puts will propel higher. For example, if trend is up and momentum is strong, put premiums would head lower, but call premiums would rise so fast that premiums when combined together would still trend higher. This is where you will profit a great deal. Now, while straddle and strangle strategy can be created based on option Greeks and prevailing market conditions, what I am going to show here is based on charts alone. This will help you identify precise moments when you would plan for a trade based on what straddles and strangles suggest. Now, this chart that you see in front of you is a strangle chart for Bank Nifty. Bank Nifty here is trading at 27,500, and in order to create a strangle, I have added premiums of 28,000 call option and 27,000 put option. Now, a couple of observations I want to point out. At 27,500, strangle of Bank Nifty is already heading lower. Look at how price then struggles to move higher and remains range bound before it moves lower. During this entire duration, Bank Nifty strangle was moving lower to consolidating sideways, clearly reflective of the fact that sustainable momentum is missing in Bank Nifty. In this case, call saw maximum premium erosion. Now, as Bank Nifty rebounded from 26,500 and moved back to 27,500, it was puts that saw fall in premium. So while Bank Nifty broadly remains at 27,500 over 20 to 25 days, both calls and puts saw fall in their respective premium levels. If Bank Nifty had been strong on momentum, Strangles would have gained in value and this would have reflected the same. Let us now come to the relevance of Straddles and Strangles. If you're a short-term trader and like trading weekly options, then you should be focusing on Straddles alone. This is mainly because out of the money weekly options lose premium fast and hence you need to select at the money strike prices to minimize the effect of time decay. This way, you would have enough room to make decent returns while being exposed to limited risk. If momentum picks up on the upside or downside, odds will be high for you to profit from it. This is only when you're looking to buy a straddle. Now, as a rule of thumb, avoid selling weekly straddle or strangles. This is advertised as a low risk strategy, but in turn, this can wipe out your account in a matter of minutes. That is, if you are over leveraged. In this example in front of you, Bank Nifty has largely remained in a range, but look at how Straddle has behaved. As Bank Nifty has moved up and down in a broad range, Straddle has consistently lost value over a period of time. Now for a trader, this is significant information because if I am planning to take a trade anywhere in this range, I would know through Straddle that momentum is lacking in Bank Nifty and hence I would take positions accordingly. I hope this particular point is clear, and from now on make it a point to track straddle or strangle of the index or stock you trade on a consistent basis. If you are more of a positional trader, then you should prefer strangles and you should prefer it in the first week of the series. Always remember that strangle should be created out of monthly options only. This way you can control risk better. With monthly options, you still have time at your side and hence premium decay is limited when you compare it with weekly options. This is to be used when you want to participate in stock or index on a positional basis. Now buying straddles and strangles is safe and the maximum you will lose is the premium you pay to trade this strategy. However, there are some implied volatility related rules you need to follow and I will come to this at a later stage. Now, one of the most important applications of straddles and strangles is that it helps you identify trending and non-trending phases. If you look at the chart in front of you, in the first half, Bank Nifty was relatively flat and drifting lower. Look at what was happening to strangles here. Value of strangle was steadily moving lower. This represented lack of trend and lack of momentum. In the first week of March, strangles broke out of range along with price. This was one of the first indication of trending move developing in the market. As trend progressed with momentum, look at how strangles moved higher with time. Now what has happened here is that as price has moved higher, put options premium have moved lower. But looking at the momentum on the upside, premium of calls have risen at such a rate that they have compensated for fall in premiums of puts. I hope this particular aspect is clear. So whenever you spot such thing happening, always take note of the trend and underlying momentum. Try and participate in the direction of trend and avoid taking any counter trend positions. One more application of straddles and strangles is in options writing. Now a lot of traders sell calls and puts together to collect premiums till expiry. Essentially they are selling either straddles or strangles. In most cases it is strangles that are being sold. Now, while this is a valid strategy, knowing when to sell straddles and strangles is equally important. Now, selling straddles or strangles on a consistent basis without knowing when to do so can expose one to risk if volatility expands. Remember one thing, that selling straddles or strangles is not a risk-free strategy. Both these strategies involve a lot of risk. Also remember that volatility plays a huge role in determining whether you should write straddles or buy straddles. I will cover more on this in detail towards end of this video. Now as a rule of thumb, do not get into the habit of writing straddles or strangles in all market conditions. There are only specific conditions when you should be attempting to do this. Now the most common question asked is whether one should be looking to buy straddles or strangles. Well, the answer for this is an emphatic yes. However, before doing so, you should be aware of underlying price action, trend bias, and volatility. Without considering these aspects, you will be heading for whipsaws in your own trading account. Now, in a couple of slides, I will be explaining specific rules when you have to buy straddles and when you should be looking into writing straddles or strangles. Let us now understand the role of volatility in straddles and strangles. Now, as a rule of thumb, when volatility is expanding, never think about selling straddles or strangles. As volatility expands, you should be looking into buying straddles or strangles. This is mainly because as volatility expands, premium of call or put would rise as well, and this in turn would lead to rise of straddle or strangle. Therefore, you should be in a position to capitalize on volatility expansion. Now, when volatility completes an upcycle and starts heading lower, this is when you should target selling straddles or strangles. You need time decay to work in your favor, and with volatility cooling off, premiums would fall at a faster pace due to time decay. Therefore, if volatility is expanding, think about buying, and when volatility is contracting, think about selling straddle or strangle. I will cover more on this when I cover the implied volatility section. Now, in this example in front of you, as volatility was moving lower, price was relatively flat and in a range. Now, as soon as volatility has shifted its range, look at the impact on trend and look at the impact on value of straddle. Now, this is what you have to target if you are a straddle buyer. Always account for volatility expansion and volatility contraction, and then accordingly choose whether you have to buy a straddle or write a straddle. So let us now move to a couple of important points before we move to implied volatility section. Now, while using straddles and strangles, situational awareness is more important. What I mean by this is that you need to be aware of bias of trend, volatility cycle in general, and aware about some major events that are lined up. One more important point I want to highlight is that treat straddles and strangles as investment in time and volatility. Avoid treating these as speculative instruments. This is the only way to be disciplined in this. You will see countless examples around you where speculation in these has led to massive losses for traders, and hence always keep this in mind. So let us now come to the section of when to buy straddles and strangles. One of the first things I look for is recent price action in terms of wide range strong bullish or bearish candles. Now, wide range candles represent buyers or sellers' interest and the strength behind the move. Since you want straddles or strangles to move, presence of strong sellers or buyers is a must. In the chart in front of you, strong candles were absent for the first 2 months of 2019. I could just spot one strong bearish candle in January. When you spot such price action, do not buy straddles or strangles. Second thing I look out for is to check whether price is in a range or is trending higher or lower. If price is in a range, there is no point buying straddles strangles as premium would eventually fall due to time decay. In the Bank Nifty chart in front of you, between January and February, price was fixated in this range. Most candles in this range were small and lacked any significant momentum. Without momentum, time decay would again eat into your premiums. Therefore, make sure that element of momentum is clearly visible. Third thing that I would look out for is implied volatility. Let me now explain this in detail. So let us now consider the role of implied volatility in deciding whether one has to buy straddle strangle or write one. Rule number 1. If IV is heading higher, do not attempt to write or short sell. Premiums will expand and your potential loss could be unlimited. Rule number 2. If IV reaches the bottom end of volatility range or it breaks out after a prolonged range movement, only then consider buying straddles and strangles. Rule number 3. Write straddles and strangles when IV cycle has completed on the upside and is clearly heading lower. If you look at the chart in front of you, I have taken 60 days of IV data for Bank Nifty. Now, prior to March, Bank Nifty IVs were struggling between 13 and 16 level. This was the right time perhaps to attempt writing straddles and strangles. However, in the first week of March, IV actually staged a breakout and headed towards the region of 1820. Now this movement was happening after a long time, and hence this was one of the first signs of premium expansion in options segment. During this time, IV was also trading above its 6-month average like I've shown on the chart. If you want to buy straddles and strangles, make sure you have price action, IV trend and momentum on your side. You can buy in both bull and bear market. On the other hand, if you're looking to ride straddles and strangles, make sure you do so only in a bull market. In a bear market, managing huge gaps can get difficult. Now do keep these two important aspects in mind. So straddles and strangles both provide incredible opportunity for trader to profit with limited risk. However, be mindful of the IV cycle and be disciplined based on the rules explained here. Most importantly, always account for price action, implied volatility cycle, and the bias of trend. Now to get these charts, you will need a software and data provider. You can look into ME Broker software and Ninja Trader software for this. You can try out True Data or Global Data Feeds as data provider for option segment. Now option segment is not yet available on TradingView and investing.com, but based on some updates I read, it would be added in the future. You can also download data from nseindia.com and plot it on a spreadsheet. But this way you would only get end of the day data. So kindly consider hitting the like button and sharing this video if you find the content useful. Thanks a lot for watching this video guys. Take care and be safe.